Welcome back everyone, I hope you're doing well, and in this video, we're going to take a look at some high dividend paying stocks that Jim Cramer believes will benefit if there's an increase to the capital gains tax for the wealthiest investors. And he believes if the capital gains rate gets increased to just below 40% and the dividend rate stays the same at a max of 20%, it's going to drive a change in the market, and wealthier investors are going to transition away from the high growth companies and into more income producing assets that are taxed at a lower rate. And he put together a list of 10 different dividend paying companies, and I went through them all and I've chosen the top 4 that we're going to go over in this episode. And for each of the companies, we're going to take a look at their current financial position, some recent news regarding their operations, and their current dividend info and the growth over the next few years. And before we take a look at the 4 high dividend paying companies, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And the first high dividend paying company that we're going to take a look at in this episode is ticker ABBV, which is Abbvie. They currently trade for $111 per share, and they've grown by 33% over the past 12 months. They have a market cap at $196 billion and are trading with a very low forward PE, right around 9, and a massive dividend yield of 4.67%. So even at this current level, when they've grown significantly over the past 12 months, they have a very nice high dividend, the company's still trading at a very reasonable valuation and a forward PE, only at 9 compared to the S&P 500, which is currently sitting with a forward PE ratio right around 24. So a lot of value coming from this company, even at their current level. And Abbvie is a top player in the pharmaceutical space, and the company owns the market leading product across 5 different consumer categories, and they own a majority market share in 4 of the 5, which is incredibly impressive. So right now the company is dominating their respective industries, and they're expected to maintain this market leadership position for long into the future. And since this company was split off from their old parent back in 2013, they have posted some incredible growth. Their annual earnings are growing at over 13% per year over the past 7 years. Their adjusted earnings per share is growing at a rate close to 19% annually, which is absolutely incredible. And their total shareholder return over the past 7 years is at 342%, which is absolutely amazing. And what's incredibly impressive is that over the past 7 years, their annual dividend per share is up 225% overall. In a 7-year span, their dividend is up 225%, and this has been a dividend investor's favorite company to own. And going forward, although they do have some issues with their debt, the company has a strong plan to reduce it and improve their liquidity over the next few years. And what's really impressive is they have a massive pipeline of products that are expected to generate huge sales by 2025 in the range of over $15 billion. So the company does have some plans for future expansion. And if we take a look at their current dividend information, they have a yield right now of 4.67%, and getting yield above 4% is getting harder and harder as the market continues to climb to new all-time highs. And when you buy into this company, their current net income payout ratio is only at 42%, which is very low and very sustainable. And they grow that payment, averaging 18% annually over the past 5 years, which is absolutely incredible once again. So you're getting to a company who's been growing their dividend every single year since they were split off from their parent back in 2013. You can get a nice high starting yield, some nice long-term share price appreciation, and your annual passive income is growing at a very fast rate. So this was one of the first companies that Cramer included in his list of some high dividend paying stocks that may benefit if some of the wealthiest investors on the market transition a portion of their portfolio out of growth and into some more passive income plays due to the lower tax rate. And now if we move on to the second pick from his top 10, we have AT&T, which currently trades for $30 per share, and they're up 4% over the trailing 12 months, and the company has a market cap at $220 billion with a massive dividend yield of 6.73%, and once again, trading at a very reasonable valuation relative to the overall market with a forward PE of only 9.73. So AT&T has been one of the top companies for investors looking for that high current income, and with a yield just under 7%, you can find that with this big name telecom company. And they just shared their Q1 2021 numbers, and they did very well. Their wireless subscribers grew year over year, their AT&T Fiber subscribers grew as well, and HBO Max posted another strong quarter, growing to over 44 million domestic subscribers. And we can see all of their business categories continue to grow quarter over quarter, which is a great sign for the company's long-term, consistent, and expected growth over the next 5 years. And in Q1, their earnings per share grew 2 cents over the prior year, total revenue was up as well, and their total free cash flow hit $5.9 billion over the past 3 months. And although a lot of investors are worried about the safety of AT&T's dividend, right now, their free cash flow payout ratio is only at 63%, and the company's CEO has reassured their shareholders that the dividend will not be cut and they can afford to pay out at their current level, reduce their debt, and fund the future growth of the company over the next few years. So right now you can buy into this company. The CEO, if he's accurate, doesn't believe the dividend will be cut, and they do maintain a sustainable cash flow payout ratio of only 63%, so they can maintain their debt reduction level and their goals while continuing to pay out that very nice high passive income, which could be very attractive to investors looking for that high income at this current point in time, rather than the long-term share price appreciation you could find with some other options on the market. And if we take a look at HBO Max, which many people believe is the future of this company, their global subscribers grew drastically year over year, and in Q1 2020, they had just over 53 million, and that has grown by 10 million new subscribers by the end of Q1 2021, and we can see domestically, they're growing at a very fast rate as well, and as the platform continues to put out new content every single month and every single year, the overall attraction to the network will grow, and they're projecting that by year end 2025, HBO Max will cross 150 million subscribers, and that'd be absolutely incredible and have a lot of consistent cash flow coming in to AT&T. And now if we take a look at the company's dividend scorecard, if you buy into AT&T at their current share price, you're getting a yield of 6.73%, and the annual payout per share is at $2.08. Their current net income payout ratio is just above 65%, and their 5-year dividend growth rate average is at 1.83%. But like I mentioned, in 2021, they're going to maintain their current level of $2.08 per share. And over the long term, the company, I believe, is still trading at a very attractive level, and the forward PE of only 9.73 really doesn't include much growth that could be coming as 5G continues to expand, HBO Max grows as well, and overall, if they can reduce their debt and improve the balance sheet, AT&T may be a company with a share price worth much higher than where it is today, providing consistent and growing income for long into the future. So that was the second company included in Cramer's top 10 list. And now if we move on to my third pick of his top 10 companies, it is ticker PFE, which is Pfizer. They currently trade for $38 per share, and over the past 12 months, they are only up 3.5%. So although they are one of the leading companies helping us get out of this global pandemic, the company's share price really hasn't reflected all of that positive news. And at this current level, they have a yield right above 4%, a current market cap at $215 billion, and a forward PE of 11.65. So another company with a lower forward PE and a nice high dividend above that 4% mark. And over their latest quarter, their total revenue grew 11% year over year to $11.7 billion, and the company's expenses did drop slightly, and their earnings per share grew 14% over the 2019 number. And going forward throughout this full fiscal year, they're projecting some massive growth with total revenue from around $60 to $61 billion, and that represents a growth rate of 41% over their full year 2020 number. So throughout 2021, they're expecting a huge growth of 40% in their total sales, which is absolutely incredible from a big pharma company that's been kind of neutral over the past few years. And going forward, they actually raised their guidance for their adjusted earnings per share to $3.10 and $3.20, up from their previous expectation, and the expected growth for that earnings is at 38% for the full year 2021 over their 2020 number. So they're expecting a major uptick in recovery in their total operations over the next year. And if we take a look at their current dividend, with a yield of 4%, a payout ratio of only 47% of their net income, another very manageable and safe level for this high yielding company, and they grow that payment averaging 6% per year over the past 5 years. So you're locking in a nice high starting percentage, and it's growing at a decent rate year over year as well. So Pfizer is a company that's boring. They operate in the healthcare/pharma space. Nothing really exciting going on with this brand, but as the leader in the fight against the pandemic, I think over the long term, it will drive a lot of customers and attraction to the brand. And like we saw throughout 2021, they're projecting a major expansion in their total sales and earnings. And once those numbers start to flow in over the upcoming quarters, it may lead to a rebound and start an upward trend in the company share price over the longer term. And now if we take a look at the fourth and final company from Jim Cramer's top 10, we have ticker CVX, which is Chevron. They currently trade for $102 per share, and they're up 17% over the trailing 12 months, and the company has a market cap at $195 billion. They're trading with a forward PE of 18.77 and an extremely high current dividend yield of over 5%. So of course, when oil tanked back in late 2019 and throughout 2020, Chevron got hurt very badly and the company's earnings were completely destroyed. But even throughout that tough time, the company maintained their dividend and actually grew it over that period, and going forward, they believe it is safe and they can maintain their operations even on their downside price levels. We can see during their worst case scenario, the company's dividend only makes up a portion of their total cash flow from operations. But on their upside potential, with a price around $60, we can see how fast their total cash flow expands, and the dividend seems very sustainable. And we can see throughout 2020, when a majority of their competitors saw a major decline and actually slashed their dividend, Chevron was the market leader, actually growing it even throughout this tough time. And they also maintain one of the strongest balance sheets in the industry, with net debt ratio well below all of their competitors. So for a company right now with a nice cash position, a strong balance sheet, they were able to maintain and grow their dividend through one of the toughest times for their business. It may be a nice addition to your portfolio if you expand and you believe oil is going to continue to increase and it's still going to be a large part of our society for decades to come. And at this current level, you can buy some shares of Chevron with a nice high yield of 5%. The annual payout per share is at $5.16. And although their net income payout ratio is extremely high right now, after the price of oil comes back and after the company's earnings start to flow in once again, they believe they can get that down to a much more attractive and sustainable level over the longer term. And they've been growing that payment, averaging 3.8% every single year. So your annual passive dividend income is growing at a rate faster than inflation, which is a great sign. So that was company number 4 of some of the companies that Cramer believes might benefit if some of the wealthiest investors on the market transition into some higher income portfolio assets rather than their high growth plays due to the increased capital gains. I don't think this is going to lead to a drastic change in our market, but there is some potential to see some upside in these players that come with a nice high dividend yield. And if we take a look at the entire list for full transparency, we can see Cramer included AT&T, Kinder Morgan, Chevron, Abbvie, IBM, Dow, Simon Property Group, Pfizer, Lindell, and Crown Castle. So of course, we went over the 4 companies I believe offer the best potential for long-term growth and dividend appreciation, and I picked AT&T, Chevron, Abbvie, and of course Pfizer out of these top 10. So definitely an interesting list from Cramer, a very interesting topic because these are some of the slower growth companies that produce higher income. And when you think about the wealthy who are already taxed at the highest level, you really don't think them choosing high income assets when they could go for a growth play. But if this capital gains tax does increase, it may change some investors' thinking, and these higher yield companies may see some short-term benefits. So we're going to wrap up the video. I want to thank you for watching to the end. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos, and I will see you in tomorrow's episode.